Welcome traders, thank you so much for clicking onto this video. Thank you so much for that. I really appreciate that. So I'm back again with yet another amazing video, and without further ado, let's get straight into it. So in this video we're going to be talking about how to use the ATR indicators to avoid stop hunts. So if you've been trading for quite some time, then you've probably come across this really annoying scenario where after you place an when you see a setup and take the trade, let's say for example we have maybe a support right there, then price comes to your area of value, prints a really amazing price action signal, and then after trading it, price just goes against you, hitting your stop loss. Then after hitting your stop loss, it shoots back up, going all the way to where you are anticipating it to go. Let's say you are anticipating for it to come and hit this place. Yeah, so this is what a stop hunt is. Basically it's just price coming and stopping you out before going into your favor. So if you're a trader, you've probably come across this, and it's really annoying. So please, by the way, excuse me for my drawing. I'm not a really good drawer, but I'm working on perfecting my drawing skills. So this is just basically what stop hunt is. So let me just go ahead and show you on the live markets. So here we have the AUD CHF 15-minute chart, and this is a really amazing example of a stop hunt. So let's say in this scenario you are looking for sales at this particular resistance area right here. So when you're looking for sales at this particular area right here, and let's say you place your stop loss just above the resistance, so as you can see, immediately you could have entered, price would have gone and hit your stop loss level before going directly into profit. So this is just one example. Let me try to find another example. Here we also have this another example still on the same currency pair. So as you can see, if you are probably looking for buys at this particular support area right here, let's say you could have found a signal right there and place your stop loss just below the zone, and immediately price comes, it goes slightly in your favor, comes back to take you out before going immediately straight to your take profit level. So this is what a stop hunt is. So stop hunts normally occur when the big boys, that is the big financial institutions, it happens when these big boys drive price intentionally directly to your stop loss in order to find the liquidity to take price higher. So when the big boys are trying to buy, they need sellers. So what they do is that they take price lower, inducing people to sell when it breaks the zone. Then when they sell, that is when they have enough liquidity to buy from those sellers taking price higher. So when they want to buy, they drive price down to induce the sellers and then take price higher, and when they want to sell, they take price higher, inducing buyers to buy, then sell to those buyers. So that is how the big boys trade. So by doing that, they normally stop so many people out. So that is how stop hunts normally occur. So these stop hunts, they normally occur when the volatility, when price volatility is really high. So when what I mean by volatility is just the strength of either the buyers or sellers. So when there are a lot of participants in the markets, the market becomes extremely volatile, and when there are a few participants in the markets, the volatility becomes lower. So these stop hunts, they normally occur when the volatility of price is high. So when it's high, that's when you are likely to get stopped out, and when it's low, you are less likely to get stopped out by these stop hunts. So since now we know that volatility is the main factor that determines whether there could be a stop hunt or not, by having a tool that shows volatility, you will be able to know how to place your stop loss level based on that volatility. And luckily enough, a tool that can do that is the ATR indicators. In order to find the ATR indicator, what you need to do is just click on the indicators and strategy and type in ATR. Type in ATR, and here we have the ATR indicator. So you can just delete this one here. So let me just zoom it so that you can clearly see it clearly. So this is the ATR indicator right here. This is the ATR, and its units are normally measured in terms of pips. So here we have the ATR value right here, this figure moving right here. So it changes every time I move my cursor from one price to another. So here, this is the ATR value right here. So it is normally in terms of pips. So for example, in this case, this is the AUD/CHF pair, and for this currency pair, and not only for this currency pair, but for most currency pairs, the pip value is the digit on the fourth decimal place. So right here, as you can see, the digit on the fourth decimal place is 3. So the ATR value right now is 3 pips. Okay, just ignore the succeeding value, just focus on the fourth decimal place. So right here, the ATR value is 3. Okay, and it changes as I move my cursor from place to place because the volatility increases from time to time. So right here it's 3, right here it's 6, right here it's 5, right here it's 4. So what it does is that it measures the volatility. When the volatility is high, then the pip value is normally high, and when the volatility is low, the pip value is normally low. So right here, as you can see, at this low here, right here, the volatility is 4 pips, and right here, this high, the volatility is 7. So at this point here, this is when the volatility is high, and at this point here, the market was experiencing some low volatility. Okay, so that is the ATR. So it just measures the volatility, and it is used in technical analysis to locate type periods when there is a high volatility or low volatility. So it is this indicator that is going to help you to identify areas. It's going to help you to avoid those stop hunts. So how it helps you to avoid the stop hunts is when the volatility is high. When you find a setup and the volatility is high, since the volatility is high, it means that there is a high chance that you could get stopped out by a stop hunt. So when the volatility is high, the ATR indicator shows a high pip value, meaning that you should put your stop loss a bit wider. Okay, and when the volatility is low, the ATR indicator will indicate a low pip value, and by that it will show you that you should be placing just a tighter stop loss because the volatility is low. And when the volatility is low, there is a less chance or a less likelihood of you getting stopped out by a stop hunt. Okay, so what it does is just basically show you when there is high volatility or low volatility. Okay, so now that we know that, now let us go ahead and look at how to use the ATR value to place your stop loss. So just as I have shown you right here, this is the value. Okay, and for most currency pairs, the pip value is the fourth decimal place. Okay, so right here it's 5, 4, 4, 6. So yeah, that is the pip value. And for the Japanese yen pair, the Japanese yen pairs are a bit different. Let's say GBP JPY. So for the Japanese yen pairs, the pip value is normally the second digit. Okay, so right here we have 2. So for the Japanese yen pairs, it's normally the value up to the second decimal place. So right here the pip value is 12, right here it's 9, right here it's 11, and 20. So for the Japanese yen pairs, it's a bit different, but all you have to do is just use the first 2 digits. So right here it's 24, right here it's 11, right here it's 8. So just use the first 2 digits when dealing with the Japanese yen pairs, and when dealing with the other currency pairs, just use the digit on the 4th decimal place. Okay, like in the AUDCHF, the 4th decimal place, this is the 4th decimal place right here. 3, 2, 4, 3, 4, 6, and so on and so forth. So once you have found the let's say for example right now the volatility is at 5 pips, what you do when placing your stop loss, just multiply that digit by 2. So for example right now it's 5 pips, multiply 5 by 2, and that is going to be 10 pips, and then use that 10 pips to place your stop loss. Okay, so let me just go ahead and use the examples that I've just shown you previously. So in this example right here, normally the textbooks recommend that you should be placing your stop loss just above or slightly above or below the resistance area, but as you can see at this particular point, the volatility was at 7 pips, right? So 7 pips is quite quite high. Okay, so just as I have told you previously, you take the number of pips that the ATR shows, multiply it by 2, and use that pip value to place your stop loss. So right now it's at 7, so 7 by 2 is going to be 14, and and by that you just place your stop loss at 14 pips. So right now it's at 14 pips, and take profit of course right here. So just by using the ATR, you could have been able to avoid this loss and profit all the way to your take profit, and this is a good risk reward ratio of 1:2. So just by using the ATR, you could have avoided that particular loss, because the volatility was quite high, and because the volatility is quite high, that indicates that there is a high likelihood of a stop hunt occurring, and since that there is a high likelihood of that happening, then the best thing to do is to place your stop loss a bit wider, and the ATR has helped us to place our stop loss a bit wider, thus helping us avoiding this loss that could have occurred right here. Okay, so let's go ahead and look at the other example. So right here at this particular point, if you could have been looking for your selling opportunities, as you can see the ATR is at 4, so 4 by 2 is 8 pips. So at this particular point, the best place to put your stop loss would have been at 8 pips. Yeah, so now it's at 8 pips. So this is also another example where the ATR could have helped you to avoid such a loss, whereby the volatility is quite high, it's slightly high. So since it's slightly high, the pip value, the value of the ATR is also slightly high. So just by using the ATR, you could have been able to avoid this loss. So that is how you use the ATR. All it does is just tell you when just show you whether the market is on high volatility or on low, and then helps you to place your stop loss based on that. Okay, so when there's high volatility, you should use a wider stop loss. When there is low volatility, you should use a tighter stop loss. So that is how you use the ATR indicator to avoid stop hunts. So go through this video over and over again until you have mastered whatever it is that I have talked about. In case you have any questions regarding how, in case you have any questions, just that is in case you haven't understood any concept that I've taught, just don't hesitate to ask in the comment section. I'll be more than happy to reply to you. So again, go through this video over and over again, and also backtest it on demo. I'm telling you, you're going to see the results. You're going to see good results out of just using this particular indicator. It's going to help you avoid so many losses. Okay, yeah. So with that said, wish you all the best and have a good life.